collapse of Lehman Brothers has become the face of the 2008 crisis. At the time of its bankruptcy, Lehman Brothers was the fourth largest investment bank in the U.S. Fast forward to the present day, and a similar situation is playing out with Silicon Valley Bank, or SVB for short, and Silvergate Capital. Hello and welcome to today's video. We will discuss the factors leading to the collapse of Silicon Valley Bank. And perhaps the most important question is, does this unfortunate event mark the start of the next financial crisis? Like the collapse of the Lehman Brothers in 2008, many will want to know what led to SVB's failure. Was it poor risk management, external factors, or a poor business model? What does it mean for the banking industry, and will it affect the Fed's action on interest rate decisions? By the end of this video, you will have better clarity on SVB's collapse, contagion risks, and the government's rescue plan to make depositors whole. Let's start from the beginning. Who was Silicon Valley Bank? Silicon Valley Bank was founded in 1983 at a time when the banking industry did not understand startup companies at a higher level. For the bank, this was a market opportunity they could capitalize on, and they did so for 39 years until its collapse on 10 March 2023. The bank understood that startups do not immediately generate revenue. This pushed SVB to manage risk based on each startup's business model. The bank's strategy hinged on collecting deposits from venture-backed companies and keeping those companies as clients when they transitioned from being startups. SVB grew tremendously during the pandemic years as tech companies were on the rise due to an increase in demand for gadgets and digital services. It was the go-to bank for tech startups. The rise in tech startups was a boom for the bank. At the time of its collapse, half of its clients were venture capital-backed tech and life sciences companies. What led to SVB's collapse? SVB failure can be attributed to a mix of factors that include poor risk management and a bank run orchestrated by VCs. SVB took deposits from tech companies which the bank used to buy long-term bonds at low interest rates. Since 2022, the Federal Reserve has been raising interest rates to fight inflation. This sucked liquidity out of the market. In the end, companies were not making fresh deposits to the bank. For any bank to function, it needs a constant stream of deposits which it uses to carry out its operations. A lack of deposits for banks is similar to restricting oxygen to human beings. It could lead to brutal complications with undesirable outcomes. For banks, this leads to a liquidity crisis. Due to the liquidity crisis, the bank sold its treasury bonds worth $21 billion and suffered losses amounting to $1.8 billion. VCs were also urging their portfolio companies to withdraw their cash from the bank, resulting in a classic bank run. The run on the bank saw deposits pull out $40 billion after SVB indicated that it needed to raise $2 billion. SVB's CEO is said to have sold shares worth $3 million a day before its collapse. On March 10th, SVB's shares tanked 80% in a single day, dragging down the banking industry with it. Silicon Valley Bank's collapse was not an isolated incident. Silvergate Capital, a bank servicing the crypto industry, announced it was shutting down its operations and liquidating. The alarm bells for Silvergate's demise started ringing after FTX's bankruptcy in November 2022. Two major banks servicing the tech industry collapsed during a tumultuous two-day period, raising fears of an impending financial crisis. The two bank collapses exposed the fragility of fractional banking. For many people, this was familiar territory. They know that if the bank collapses are not contained, the contagion could spread like wildfires and have far greater implications. The SVB collapse could hurt startups. Remember that startups do not generate any revenue in their initial phases. This may leave some startups unable to meet their financial obligations as they relied on SVB. This collapse will not have a big effect on the financial system, but will shake the startup tree for some time. As was the case in 2008, authorities are expected to step in. The 2008 bailout came at $489 billion, with then-President Barack Obama claiming in 2012 that the government recovered every dime it used in rescuing banks. Will the U.S. government take a similar route this time around? While many people were still digesting the collapse of SVB, U.S. regulators shut down Signature Bank to nip systemic risk in the bud. Based in New York, Signature was a big lender in the crypto industry. In a matter of days, 3 banks have gone belly up. These are 1. Silvergate Capital, 2. Silicon Valley Bank, 3. Signature Bank. One could be forgiven for thinking that the banking gods have something against banks that start with the letter S. Let's get down to how U.S. authorities may have averted similar future bank runs by coming up with an urgent plan. Firstly, President Joe Biden's administration said that customers of the failed SVB will be made whole. Secondly, Treasury Secretary Janet Yellen, Fed Chair Jerome Powell, and Federal Insurance Deposit Chairman Martin J. Grunberg released a joint statement stating that the FDIC will make sure that the clients of SVB and Signature Bank will get their money back. According to December 2022 filings, about 85% of SVB's deposits were uninsured. The government is guaranteeing all deposits to restore faith in the country's banking system and avert possible bank runs that up until the intervention looked very certain. The Fed will also avail additional funding for qualifying financial institutions to keep them afloat. This action taken by the government is a clear indication that it does not want to leave the risk of further contagion to chance. The government plan appeased investors as the announcement was followed by a noticeable rally in the financial markets. The Dow Jones Futures rose 0.9% after the announcement. The crypto industry was also in the green as Bitcoin's price went up from around $20,000 to more than $22,000 in a matter of hours. The Fed has come up with the new Bank Term Funding Program to avoid the SVB. Some people may argue that the Fed's aggressive rate hikes may have partly contributed to SVB's collapse due to a lack of liquidity. Goldman Sachs analysts predicted that the Fed will go easy on interest rate hikes in the wake of SVB collapse. If this happens, there may be more liquidity in the markets, and this could spark a rally. Do the three bank failures mark the beginning of the next financial crisis? Initially, this seemed likely as fears of contagion risks were spreading. There was no way that future bank runs could be ruled out, as depositors were likely going to make withdrawals en masse. Treasury Secretary Yellen cooled down fears by playing down the failure of SVB, the 16th largest bank in the U.S., claiming that it is an isolated incident that shouldn't cause any panic. The truth is that the financial system is very fragile, and it only takes a small, unintended event to start a crisis with domino effects. As was the case during the pandemic, the Treasury will provide $25 billion in credit protection to help banks against losses. This gives banks access to cash when they need it. SVB failed to get cash injection as early as possible. The Fed is also in on the Rescue Act. It is offering banks loans of up to 1 year in exchange for mortgage-backed securities and U.S. Treasury bonds that have lost their value. In the short term, a financial crisis has been avoided. In the long term, there are questions of whether the rising interest rates could leave other banks in a vulnerable position that led to the collapse of SVB. However, SVB's failure leaves the tech sector in a concerning position. The tech sector has been laying off employees to save cash amid the market downturn. SVB, one of the financial backers of the tech sector, has gone under when the sector needed the bank the most. The curtain has finally come down on SVB, Silvergate, and Signature Bank. The U.S. government has made it clear that it is not bailing out the banks. Instead, its obligation is on making depositors whole. However, the bank's shareholders and some unsecured creditors may lose some of their money. The Fed will need to rethink its interest rate hikes and the impact they will have on the balance sheet of companies. If the current financial conditions persist, there is a high chance that a financial crisis is on the cards. The SVB collapse is an appetizer of what may come in the future. The SVB collapse is not a Lehman Brothers moment. It's a lesson on risk management, a reminder that a bank run can happen at any time, and a clear warning that a financial crisis may only be a stone's throw away.